Well, ladies and gentlemen, Vice President and I are very pleased to welcome you to our press conference. We will now report on the outcome of today's meeting of the Governing Council. Based on our regular economic and monetary analysis, we decided to keep the key ECB interest rates unchanged. Incoming information confirms that the moderate recovery of the euro area economy is proceeding in line with our previous assessment. At the same time, the latest ECB staff macroeconomic projections, now covering the period up to the end of 2016, support earlier expectations of a prolonged period of low inflation to be followed by a gradual upward movement in HICP inflation rates towards levels closer to 2%. In keeping with this picture, monetary and credit dynamics remain subdued. Inflation expectations for the euro area over the medium to long term continue to be firmly anchored in line with our aim of maintaining inflation rates below but close to 2%. Regarding the medium-term outlook for prices and growth, the information and analysis now available fully confirm our decision to maintain an accommodative monetary policy stance for as long as necessary. This will assist the gradual economic recovery in the euro area. We firmly reiterate our forward guidance. We continue to expect the key ECB interest rates to remain at present or lower levels for an extended period of time. This expectation is based on an overall subdued outlook for inflation, extending into the medium term, given the broad-based weakness of the economy, the high degree of unutilized capacity, and subdued money and credit creation. We are monitoring developments on money markets closely and are ready to consider all instruments available to us. Overall, we remain firmly determined to maintain the high degree of monetary accommodation and to take further decisive action if required. Let me now explain our assessment in greater detail, starting with economic analysis. Real GDP in the euro area rose by 0.3% quarter-on-quarter in the last quarter of 2013, thereby increasing for 3 consecutive quarters. Developments in survey-based confidence indicators up to February are consistent with continued moderate growth also in the first quarter of this year. Looking ahead, the ongoing recovery is expected to proceed, albeit at slow pace. In particular, some further improvements in domestic demand should materialize, supported by the accommodative monetary policy stance, improving financing conditions, and the progress made in fiscal consolidation and structural reform. In addition, real incomes are supported by lower energy prices. Economic activity is also expected to benefit from a gradual strengthening of demand for euro area exports. At the same time, although unemployment in the euro area is stabilizing, it remains high, and the necessary balance sheet adjustments in the public and private sector will continue to weigh on the pace of economic recovery. This assessment is also broadly reflected in the March 2014 ECB staff macroeconomic projections for the euro area, which foresee annual real GDP increasing by 1.2% in 2014, 1.5% in 2015, 1.8% in 2016. Compared with the December 2013 Eurosystem staff macroeconomic projections, the projection for real GDP growth for 2014 has been revised slightly upwards. The risks surrounding the economic outlook for the euro area continue to be on the downside. Developments in global financial markets and in emerging market economies, as well as geopolitical risks, may have the potential to affect economic conditions negatively. Other downside risks include weaker than expected domestic demand and export growth and insufficient implementation of structural reforms in euro area countries. According to Eurostat's flash estimate, euro area annual HICP inflation was 0.8% in February 2014, unchanged from the upwardly revised outcome for January. While energy prices fell more strongly in February than in the previous month, increases in industrial goods and services prices were higher than in January. On the basis of current information and prevailing future prices for energy, annual HICP inflation rates are expected to remain at around current levels in the coming months. Thereafter, inflation rates should gradually increase and reach levels closer to 2%, in line with inflation expectations for the euro area over the medium to long term. This assessment is also broadly reflected in the March 2014 ECB staff macroeconomic projections for the euro area, which foresee annual HICP inflation at 1% in 2014, 1.3% in 2015, and 1.5% in 2016. In the last quarter of 2016, annual HICP inflation is projected to be 1.7%. In comparison with December 2013, Eurosystem staff macroeconomic projections, the projection for inflation for 2014 has been revised slightly downwards. In view of the first publication of a three-year projection horizon in the March 2014 ECB staff macroeconomic projections, it should be stressed that the projections are conditional on a number of technical assumptions, including unchanged exchange rates and decline in oil prices, and that the uncertainty surrounding the projections increases with the length of the projection horizon. Regarding the Governing Council's risk assessment, both upside and downside risks to the outlook for price developments are seen as limited and are considered to be broadly balanced over the medium term. Turning to the monetary analysis, data for January 2014 confirm the assessment of subdued underlying growth in broad money, M3, and credit. Annual growth in M3 increased to 1.2% in January from 1% in December. The monthly inflow to M3 in January was substantial, compensating for the strong outflow in December. The increase in M3 growth reflected a stronger annual growth rate of M1, which rose to 6.2 from 5.7 in December. As in previous months, the main factor supporting annual M3 growth was an increase in the MFI net external position, which continued to reflect the increased interest of international investors in euro area assets. The annual rate of change of loans to the private sector continued to contract. The annual rate of change of loans to non-financial corporations was minus 2.9%, unchanged from December. Weak loan dynamics for non-financial corporations continue to reflect their lagged relationship with the business cycle, credit risk, and the ongoing adjustment of financial and non-financial sector balance sheet. The annual growth rate of loans to households stood at 0.2% in January 2014, broadly unchanged since the beginning of 2013. Since the summer of 2012, substantial progress has been made in improving the funding situation of banks. In order to ensure an adequate transmission of monetary policy to the financing conditions in the euro area countries, it is essential that the fragmentation of euro area credit markets declines further and that the resilience of banks is strengthened where needed. This is the objective of the ongoing comprehensive assessment by the ECB, while a timely implementation of additional steps to establish a banking union will further help to restore confidence in the financial system. To sum up, the economic analysis confirms our expectation of a prolonged period of low inflation to be followed by a gradual upward movement towards levels of inflation closer to 2%. A cross-check with the signals from the monetary analysis confirms the picture of subdued underlying price pressures in the euro area over the medium term. As regards fiscal policies, the ECB staff macroeconomic projections indicate continued progress in reducing fiscal imbalances in the euro area. The aggregate euro area general government deficit is expected to have declined to 3.2% of GDP in 2013 and is projected to be reduced further to 2.7% of GDP this year. General government debt is projected to peak at 93.5% of GDP in 2014 before declining slightly in 2015. Looking ahead, euro area countries should not unravel past consolidation efforts and should put high government debt ratios on a downward trajectory over the medium term. Fiscal strategies should be in line with the Stability and Growth Pact and should ensure a growth-friendly composition of consolidation, which combines improving the quality and efficiency of public services with minimizing distortionary effects of taxation. National authorities should also continue with the decisive implementation of structural reforms in all euro area countries. These reforms should aim in particular to make it easier to do business and to boost employment, thus enhancing the euro area's growth potential and reducing unemployment in the euro area countries. To this end, the Governing Council welcomes the European Commission's communication of yesterday on the prevention and correction of macroeconomic imbalances and on the excessive deficit procedure. Looking ahead, it is key that the macroeconomic surveillance framework in the euro area, which was significantly strengthened in the wake of the sovereign debt crisis, is implemented fully and in a consistent manner. We are now at disposal for your questions.
Brian Blackstone, Wall Street Journal.
Brian Blackstone with the Wall Street Journal. You placed a lot of emphasis on this meeting. You said you'd have the information that you needed on a variety of factors affecting your reaction function today, and you've done nothing. You've said that you stand ready to take decisive action if needed, but presumably all central banks are willing to take decisive action if needed. Isn't it reasonable, given that you've done nothing today, to just, for investors and the public, to assume that you're just done, barring some big outside shock? And my second question is on the euro. You mentioned that your inflation forecast assumes an unchanged euro. To what extent is the strength of the euro affecting your inflation outlook? And are you surprised that it's at its strength, given the comparative weakness of the eurozone recovery and the fact that you've got this easing bias and you've got this forward guidance? Thank you.
Thank you. The reason for today's Governing Council's decisions are the following. First of all, we saw our baseline by and large confirmed. There is a continuation of a modest recovery. In the last quarter of last year, we had an increase in the GDP of 0.3% after 2 consecutive quarters of positive growth. The news that have come out since the last monetary policy meeting are also, I would say, by and large on the positive side. We had a data, just let me give you a few of them, not all of them, but the composite PMI data that's just come out. It's the strongest in 2.5 years. The PMI services also was quite good. That's quite important because job creation takes place mostly in the services sector. When we look at consumers' confidence, we see that the gap between Germany and the stressed countries, especially Spain and Italy, is actually narrowing. And so is the data on economic sentiment produced by the Commission. It is true unemployment is still high, but it's stabilized. It's now a few months that the unemployment has stopped going up. We actually have some data, local data, like the fall in 2%, the fall of 2 percentage points in unemployment in Portugal, which are quite striking. We also saw that the employment data are just timidly going up. So having said that, the risks are on the downside, but basically, when we looked at all the amount of information we had in front of us since the last monetary policy meeting, we thought that our monetary policy stance would remain accommodative. Our forward guidance is confirmed in saying that interest rates will stay at the present or lower level for an extended period of time. And we asked ourselves whether the contingencies that I hinted at last time that would actually elicit monetary policy decisions had taken place. You may remember one of these contingencies was an unwanted tightening of monetary policy on the short-term end of the market. In fact, if anything, we had a normalization, further normalization of conditions on that front. And so the other was a consistent and significant worsening of the medium-term outlook for our price stability, for our inflation outlook, and that too isn't there. So all in all, I think that based on the current set of decisions, the Governing Council decided not to act today. Now, on the second question, there is no doubt. I mean, let me start first with the standard statement. I mean, the exchange rate is not a policy target for us. But the exchange rate is very important for growth and price stability. And there is no doubt that if we look backward to the trough of 2012, to the trough in the exchange rate in 2012, and we look at the exchange rate today, and we ask ourselves the question, how much has this counted for the low inflation that we see today? We come up with the number, with a figure which is roughly 0.4. And so I think I will come back on this if I have questions on inflation. But that's a significant statement on how the exchange rate might influence our price stability objective. Thank you.
Leica Chiara, Reuters.
Hello. Hi, my name is Leica Kihara. I'm a reporter for Reuters, actually visiting from Tokyo. I usually cover the BOJ. I have two questions. The first question is, there was market expectations that today the ECB might decide to stop sterilizing S&P program. Is there any reason this wasn't decided today? My second question, I have been covering the BOJ in Japan for 15 years. So I saw Japan slipping into deflation and staying there, suffering from it. I know it's not good to draw a direct link between Japan and Eurozone, which is very different, and for reasons laid out at your presser last month. But what are the key lessons you think the Eurozone can learn from Japan's experience? I ask because you say that long-term inflation expectations are well anchored, but inflation expectations are very hard to measure. And even in Japan, long-term inflation expectations have been very stable, even when the country was suffering from deflation. Also, the BOJ introduced zero rates. It flooded markets with liquidity to beat deflation, but it couldn't really push up prices. So I wonder why in the Eurozone, cutting rates or doing any stimulus activity would prevent the area from slipping into deflation or prevent prices from falling. I just want to know what the transmission mechanism is different from in Japan. Thank you.
Thank you. On your first question, certainly the suspension of sterilization of the S&P program is one of the instruments that is in our list, but we didn't see any development in the money, as I said before, in the money market that would lead to an unwanted tightening of the monetary conditions that would justify the use of this instrument. So we haven't seen this contingency happening. Let me also add that the benefits of such sterilization are relatively limited given the short maturity of the bonds currently present in the S&P portfolio. So the injection of the liquidity would really last only a relatively short time, less than a year for sure. But in any event, we'll continue to monitor the situation, and we'll look at this as well as other instruments in our catalog. On comparisons with Japan, I think I've been on discussing this on other occasions as well. Let me say why we think that our situation is different. First of all, in our case, it's true, inflation expectations are firmly anchored. They were not in the case of Japan. They de-anchored at some point. You are right, inflation expectations, medium to long-term inflation expectations are hard to measure, but this is the measure that the ECB has had in place, both when inflation was high and when inflation is now low. And on both occasions, we all remember conversations and discussions about the validity of these expectations. They could de-anchor themselves both upward and downward. But by and large, they helped ourselves to deliver during the whole lifetime of the ECB our objective of an inflation rate which is close but below 2%. So in a sense, the definition of inflation expectations that we've been using throughout our life warranted our credibility in delivering the inflation target. But there are other reasons why the condition of Japan was different. And one of them is that we have taken, and we're still taking really, early decisive action on the monetary policy front. It's now several years that we continue to take action, and as you yourself realize, you come here every time expecting action from us, and you're slightly disappointed every time we don't take action, even though we take action very often. So that shows by itself that we've been everything but inactive, certainly not inactive. The second reason is that the condition of the balance sheets of both companies and banks in the euro area today is not what it was in Japan at the end of the 90s and in the early 2000s. There are also other statistical measures. For example, we constantly ask ourselves, what is the percentage of commodities or services, the price of which fall? In other words, the inflation, the price inflation of which is negative or less than 1%. And the percentages that we watch, that we see, are much lower than what they were in Japan at that time. So all in all, we believe that the situation is different. There are other reasons, however, that deal really more with the explanation of our low inflation itself than in comparison with Japan. I hinted before at the fact that we have global factors at play, low energy prices. For example, let me give you another data. The average historical contribution to inflation coming from the price of energy is 0.5%. More specifically, in the early 2012, this contribution was still at that time 1 percentage point. In February 2014, the contribution from energy prices was minus 0.3%. So this means that of the fall of 1.9 percentage point since 2012 Q1 in HICP, 2/3 can be explained by lower energy prices. And I've said something about the exchange rate. Of course, the two things may not be, you may not add them, but there are two different effects. Global factors are at play, much less so at the time of Japan, much less so. Also, there is another dimension, which is the fact that part of this low inflation is due to relative price adjustment in stressed countries that experienced, before the crisis, serious imbalances that needed to be corrected. But I can dwell further on this.
Johanna Trick, Market News.
Johanna Trick, Market News. Mr. Draghi, earlier you spelled out quite clearly the arguments for why you decided not to cut interest rates today. I'm wondering whether all your colleagues subscribe to these arguments, or whether you had some governing council members push for an interest rate cut today, and if so, how close the decision might have been. My second question is on credit developments in the euro area. During the last press conference, you expressed hope that in the coming weeks we might actually see positive signals from credit. In light of that, I wonder whether you might have been somewhat disappointed by what we saw in the M3 data, and what you might be expecting in the weeks ahead. Thank you very much.
Thank you. On the first question, yes, indeed, we had a broad discussion of changes in interest rates, as well as other monetary policy instruments. However, if I have to sort of flag to you a key point of the discussion, is the attention that the presence of slack in the economy received during the discussion, whereby slack we mean low capacity utilization rates, output gap, which is indeed hard to measure, but according to any measure you want to take, it's fairly wide. And according to any estimate, at the present juncture is estimated to close itself very slowly. So our monetary policy stance that says what I said before, that interest rates will stay at the present level or lower, will continue even though we will be seeing improvements in the economy because of the existing slack that exists in the economy. I think this was really the point of major consensus, if not unanimity, in this discussion we had. So our monetary policy stance will stay in place even after we'll be seeing improvements in the economy, in the flow of data in the economy, because we have a stock of slack that is weighing on the economy itself. The second point, well, you know, it's always a matter of seeing the glass. You asked me if I am disappointed by the credit developments. It's like, I mean, the glass where it's half empty or not. We saw a stabilization of credit flows, and we saw an increase in M3 from the low data of M1. By the way, in December, M1 was also low because of special seasonal factors. We also, I've explained several times, I've told you several times how we should look at fragmentation. We continue seeing some improvement on that front as well. In particular, even though lending rates stay higher in the stressed countries than in core countries and higher for SMEs than for corporates, we saw some convergence in lending rates, some timid, I would say, mild convergence. We also saw another factor, that the issuance of corporate bonds completely offset the decline in bank credit, which is, to some extent, is positive news, but we shouldn't make too much out of that for two reasons. Because we know only too well that SMEs usually don't access capital markets, cannot issue bonds on capital markets, if you take exception of these mini bonds that I hear of being issued in Italy, but it's still a very experimental project. And the second thing is that much of this corporate bond issuance is concentrated in core countries and France. So it's not concentrated in stressed countries, basically. Thank you.
Alessandro Merli, Il Sole.
I'm Alessandro Merli of Il Sole 24 Ore from Italy. You mentioned geopolitical factors. To what extent were they a factor, were important in your decision today? How much they impacted your decision today? Geopolitical factors such as the Ukraine, and I would also like to ask you about the developments in emerging markets. You commented on that before, but the situation seemed to be of prolonged unease there. The other question is about credit again. The recovery can hardly happen without credit. In the past, you've alluded to several possible measures like revitalizing ABS or targeted or conditional liquidity provisions. Are they still on the table? You've been talking about this for quite a long time now. Are they still on the table? Are they not? Or have you shelved them?
Yes. On the first question, as you've seen, the impact of the situation of emerging market economies upon the euro area so far has been muted. In fact, I think if anything, there have been flows into the euro area which narrowed the spreads of some of the stressed countries. It's more and more clear that that the situation of the emerging countries depend to a great extent by the economic policies that have not been undertaken or have been undertaken in a wrong way in the most vulnerable of these emerging market economies. And I think I've said last time that we certainly cannot ignore this fact. We certainly cannot ignore that our monetary policy decisions have spillovers. And so certainly better communication is there, and we ought to pursue that. But it's also true that the best insurance against foreign spillovers is good economic policies. And third, the international financial institutions like the IMF should and could create safety nets that could help some of these countries to cope with these spillovers. So there are three sets of actors where I think the domestic governments and the IMF are the major actors, because the central banks act within their national mandates and they have to act in full independence. When we look at the specific situation in Ukraine, and if we look at that in a fairly, I would say, from a purely, I would say, technocratic viewpoint, and we look at the amount of trade in goods, services, and financial services, and flows and capital flows, we have to say that the interconnections are not as important as to suggest a strong contagion from that region. However, let me also add that this would be a limited way to look at the situation, because the geopolitical risks in the area could quickly become substantial and generate developments that are unforeseeable and potentially of great consequence. On the credit recovery, you're absolutely right. We have discussed on several times. We've hinted on several occasions at various measures. One was the ABS. Another one was the revitalization of the ABS market. And another one has been funding for lending. And a third could be QE. So we will certainly know. We have not shelved these projects. We are continuing to reflect on this, and we'll continue to work. And I think time is necessary because they are not easy. Just if we consider the ABS program, we can discuss this at great length. But if we consider just the revitalization of the ABS program, there are many things that need to change in regulation and in legislation. Today, the capital charges for ABS discriminate ABS unfavorably versus with respect to other instruments of similar degree of riskiness. The current capital regulation of ABS was calibrated on a reality which is not the European one. To give you an idea, I now can't remember exactly the period of reference, but let's say over 5-10 years, the default rate of ABS in the United States was 17.4%. In Europe was 1.4%. So you see that the capital charges have certainly been calibrated not on the European ABSs, which are traditionally of a much simpler, transparent, unstructured form. So these things have to be changed, and it will be up to the Basel Committee and up to the Commission, as far as our legislation within the EC, to change some of these regulations. Also, there are issues like the sovereign cap. ABS are rated according to their sovereign, perhaps with a few points difference, but this often doesn't make much sense. So there are several things, several issues, and in the end also it may well be the case that to launch this market one may need third-party guarantees. So it's a complex thing on which the ECB staff is working.
Bloomberg, please.
Paul Gordon from Bloomberg. Thank you very much indeed. Just want to come back to two particular questions. One is going back to the foreign exchange argument. It's not your mandate, so you've made that absolutely clear. But you have gone to the extent of working out the impact of the 2012 trough in the euro on inflation, and inflation is your mandate. So should we in some way be viewing the exchange rate as a part of the reaction function? I want to know exactly how we should look at the exchange rate. Secondly, let me ask a broader question on the Ukraine, slightly offbeat a little perhaps, but the Polish central bank governor has been suggesting Poland should rethink its discussions over whether it should be a part of the euro area or not. All of this is long-term, it's a long way off. But given the instability we're seeing at the moment around the Ukraine, does that strengthen the case for the euro? Is that an advantage?
Let me answer the first question first. I can only reiterate the exchange rate is not a policy target, and but certainly I have here another number. The cumulative appreciation of the exchange rate between the euro and the dollar since the trough of 2012 has been around 9%. In effective terms, the euro strengthened by 8% since then. Now, as a rule of thumb, Each 10% permanent effective exchange rate appreciation lowers inflation by around 40 to 50 basis points. So we can say that between 2012 and now, about 0.4, 0.5% of inflation was taken out of the present inflation because of the exchange rate appreciation. Now, having said that, we've got to be cautious about saying this because there was a previous depreciation of the euro. So that's why it's hard to make the exchange rate either a policy target or even less so a policy instrument. But it's certainly a factor that we now see affecting in a significant way, together with price of energy, as I said before, and food, for this matter, our low rate of inflation. Your second question is indeed very difficult. Let me answer. The euro is an island of stability. It will have to go back to being also an island of prosperity and job creation, but certainly is an area of stability. To the extent that countries feel threatened, that is certainly looks, this area looks certainly attractive. But I should stop here because you are aware that the foreign policy and geopolitical dimensions of these choices go well beyond the mind of a humble central banker. So, thank you.
Jean-Philippe Lacour, Les Échos.
Okay, will try my best English after this of my colleague of Bloomberg. Okay, French press is now. Mr. Draghi, you underscored a high degree of unutilized capacity in a statement which I may read this for the first time. Is it a signal that the ECB, it is a primary concern of the ECB that this unutilized capacity are at this degree in the Eurozone? And if this is the case, that is not a signal that companies will invest in new capacities. Of course, and then if they not invest, they will not require credits. So no credits, no creation of money, and then still low inflation. Do you, maybe you follow me in this argumentation? Second question. Why do you communicate, especially on the fourth quarter of 2016, regarding inflation? It is the rate of 1.7, which is above the 1.5 forecasted for 2016. This is just to say, hey guys, 1.7, we are right on the finish line, close to 2, but under, and that goal achieved. Thank you. And maybe could you tell us if there are some extreme values in this forecasting regarding inflation and, by the way, GDP? I mean, in this the corridor of the values which are below or above this 1.5, respectively 1.8 for
on your first question. See, to say that the monetary policy stance that keeps interest rates at the present or lower level will stay in place even after we'll be seeing improvements in the economy means the following. Means that the monetary policy, even if we don't do anything in presence of an improvement of the economy, will become more and more accommodative, because real interest rates will go down. That is the message that this consensus produces. And in this sense, it links with what you said before. One of the reasons, perhaps the most important reason for credit flows being weak, being low, is lack of demand. And lack of demand is also lack of investment. So the present monetary policy stance producing lower real rates should help in this sense to increase demand for credit and demand for investment, and therefore demand for credit. On the 1.7, it simply says that there is a sort of dynamic whereby, and now for the first time we can say it, I mean, not we, the ECB staff can say it even quantitatively, there is a dynamic that says that basically even though inflation now is low, it will gradually move towards a level which is closer to 2%. It's the data give both the yearly average and also the data of the last quarter to show the momentum towards 2%. But mind, as I've read in the introductory statements, the uncertainty of these projections increases with the length of the horizon. And the assumptions like unchanged oil prices, unchanged decline in oil prices, and unchanged exchange rates, and many other assumptions become more and more fragile as the horizon lengthens. So these projections must be taken with a certain degree of wisdom. Thank you.
Claire Jones, Financial Times.
Claire Jones, Financial Times. In justifying your decision not to act today, a lot of emphasis seems to be placed on recent data points. But if we look at the economics textbook, it teaches us that monetary policy acts with a lag. Now, if you look at the lag with which it's supposed to act of 2 years, we look and we see inflation still below target then. We also hear you say that there's a significant degree of slack. Both pieces of evidence that would point to taking action today. Now, a cynic might say that the decision not to act owes more to the political economy of the institution rather than the economics of the Eurozone. How would you respond to such criticisms? And a second point, you noted in your last answer that, this is based on the idea that monetary policy will become more and more accommodative as time goes on. Now, you've also mentioned that where credit conditions are working better, not just in bank lending, but in capital markets, it's the core. So there's not any evidence that you're really seeing an improvement, much of an improvement in credit conditions in the periphery. So isn't it a little bit complacent to just assume that credit conditions are just going to become more accommodative and that warrants not taking more action today?
On this last point, no, I did say that credit conditions remain weak, but we also say that credit conditions are a lagged indicator of future growth. And all in all, we see a certain stabilization of credit flows, and this is not only for core countries, but it's for everybody. So, and this is true for, in fact, if anything, lending standards became more looser in countries like Italy and to some extent Spain for certain categories of borrowers. So we see some improvement there. We see that even if, as I said, the credit flows remain weak, we see some convergence, admittedly mild convergence in lending rates between stressed countries and core countries. And I will not repeat what I've been saying now for months. We continue seeing improvements on the funding side for banks, both in the core and especially in the periphery, where in terms of dispersion in the growth rate of bank deposits, we are at the same level where we were in 2007. So if we consider funding only as far as bank deposits are concerned, we can safely say the fragmentation is over from that side. But of course, there are other aspects of fragmentation that are also very important, and we focus on what doesn't work, not on what works, really. So that's one answer about the credit. Now, you are absolutely right. Monetary policy exerts its effect with a lag. And one way to look at the recent improvements is to say that our accommodative monetary policy that's been in place for years now is finally finding its way through the economy. Now, the lag of 2 years is actually questionable, because unfortunately the lag depends on how well the transmission channels of our monetary policy work. And one of the reasons, well, and the key actor in Europe for the transmission of monetary policy are the banks. And so one of the reasons, probably one of the greatest contribution that a credible comprehensive assessment can give is actually to repair the bank lending channel and therefore speed up the transmission of monetary policy with respect to what it is today. Thank you.
Sonia Sabcheva, Focus News.
Mr. President, let me come back to the situation in Ukraine. How the Ukrainian crisis impact could affect the euro, the eurozone, the non-eurozone countries, and the European financial markets, and how? And the second question is, have you discussed any scenarios about, and if yes, which? Thank you.
I'm sorry, the second question is what?
Have you discussed the scenarios?
Scenarios. No, we have not discussed scenarios of the crisis, or what impact, of different impacts that the crisis could have. So far, we've seen a major impact on the Russian economy and on the Ukrainian economy, and some impact, financial impact, on some countries that are bordering that area. The growth impact on the Russian economy is severe. However, it's very, very difficult to foresee what is going to be the impact over a horizon of 2-3 years, because that's what we have to look at if the crisis were to continue. For example, the impact on the energy market, what could this be on Europe? If we look at the next 6 months, the answer is going to be very mild. If we look at a year and a half, it could be very serious. But it depends on so many things. It depends on alternative source of energy. It depends on how this crisis will evolve. And we, frankly, especially, as I said, we poor central bankers, don't have enough information to give a reliable assessment of the economic impact at such an early stage in the crisis. Thank you.
Stefania Tamburella.
Stefania Tamburello, Corriere della Sera, from Italy. The problem number one, maybe number two, I don't know, for European banks is the high level of non-performing loans. Do you think that the creation of the bad bank or other mechanism to split the non-performing loans is a solution, a right solution? If not, what will you suggest? So the second question, you welcome the communication commission, European Commission communication, but yesterday communication was very tough, very strict with Italy, but not only with, not even soft with France or Germany. So do you really think that more sacrifices can improve the recovery or growth?
Now, on the bad bank, or no, I think I don't want to enter into the specific instruments discussion, but certainly what countries should do, supervisors should do, and what certainly we will do with a comprehensive assessment will be to cope with non-performing loans and other factors or weaknesses in the bank's balance sheet squarely. The worst thing that one can do is to pretend the problems don't exist. If anything, an evidence from Japan of the 90s and 2000 is that zombie banks don't lend. So the idea that people are afraid of the AQR because they think that then banks will deleverage and will not lend I mean, they don't lend anyway. If they are zombie banks, they don't lend. And so that's the only possible path is to cure and proceed and being surgical if needed. So that's the purpose of the AQR, that's the purpose of the comprehensive assessment, but also I think fair credit should be given to national supervisors who, in view of the AQR, are already taking prompt corrective action in their own, with respect to their own banking systems, increasing provisions, demanding capital increases so that banks can be repaired. Now, whether a bad bank is the right instrument or not, it really depends on the specific circumstances. The important thing is to, as I said before, is to restore trust in the European banks' balance sheets. And that's the ultimate objective of the exercise, and that is the condition necessary and sufficient for the private sector to return to invest in the banking industry, in the European banking industry. Let me say about the second question. We'll certainly welcome the European Commission communication, but let me read what we said in the introductory statement. We said the fiscal strategies should be in line. Well, we said euro area countries should not unravel past consolidation efforts. It would be a disaster. If you think so much, as you said, so many sacrifices, so much pain because of the efforts that have been undertaken now, would it make any sense to go back and squander all the political and human capital that's been invested in these efforts? It does say don't unravel past consolidation efforts and put high government debt ratios on a downward path over the medium term. Fiscal strategies should be in line with the stability and growth path, but should also be growth friendly. So it's time to think or rethink about the composition of the budget consolidation efforts. And I will not dwell on this because you heard me saying this too many times, really, what I mean by rethinking the composition. So, and then it says national authorities should also continue with the decisive implementation of structural reforms in all euro area countries. That is essential. If we look at, well, there are several markets that without structural reforms will not return to functioning. One of them is the labor market, where the structural unemployment is high. And one copes with the structural unemployment through structural reforms.
So we'll take the last question from Annette Weisbach from CNBC.
Thank you very much. Here I am. My first question would be actually on OMT, because just one day after your last press conference, the German Constitutional Court came out with a non-ruling, we have to say. So, and there are opinions in the markets.
They would disagree, by the way.
Huh?
They would disagree with this definition, but it's
yeah,
you.
Yeah,
Okay.
yeah, that's true. But there are opinions in the market that for now the OMT program is on hold because the Bundesbank might not participate. So what is your opinion on that? And also, I'd like to know your opinion about the IMF calling the ECB for more stimulus in recent articles. How do you feel about that? Thank you.
Thank you. Well, let me say that OMT is ready, is there, and it's ready to be activated if and when needed. In this sense, we welcome the deferment of the OMT case to the European Court of Justice. OMT, in our view, falls within our mandate of pursuing price stability over the medium term. The IMF statement asking for more stimulus is one of the many voices asking us to do something in one direction, as many others are asking us to do something in another direction, or do nothing as well. So I think the analysis, the analysis that we do at the present time, at least with respect to this monetary policy meeting, diverges from what the IMF is saying. It's also, one should also ask the question is what kind of stimulus here? Because as I've said on and on, many of the problems that we face today are structural. Fragmentation is a structural problem. And one way to cope with fragmentation will exactly be the comprehensive assessment and the asset quality review that we'll be making. But however, let me just say one last thing with respect to that. We are now, the ECB and Victor Constancio here and Daniel Nouy are working on several tracks. They are working on undertaking the asset quality review and later the stress test. They are also working on building up a totally new institution, the SSM, where we foresee that something like 1,400 people will work for. And then the question is, what about the SRM? Will the SSM take charge at the same time as the SRM will take charge? This is an important point, because to have a single resolution mechanism working together jointly with the supervisory would align responsibilities between the supervisor, which is unique, which is the one European supervisor, together with the one resolution authority. So there would be no misalignment of responsibilities. Contrary, if we don't have a one SRM, the responsibilities for resolution will remain national. And so we will have a misalignment of responsibilities. We follow with great attention the discussion now between the Council and the European Parliament. The ECB view is that the mutualization process should be sped up, and the governance of this new institution should be effective so that the new institution, the resolution authority, could actually take the swift decisions that are in its very nature. Because as we all know, to resolve a bank is a decision that is often taken in hours. So the governance of this new institution should be such that it could decide in a matter of hours. That is, and the third point is that, of course, in order to have this gradual but not too slow mutualization, one has to have a backstop there. And the backstop can, we've been always very open, it could be a credit line from the ESM, or it could be borrowing from the markets with joint government guarantees. And finally, and we've insisted a lot on this, also with you, I think, we have to have strict separation between the supervisor's assessment and the resolution assessment. So I just want to make this point, because these are examples of structural reforms that would address a structural problem, namely fragmentation. Thank you.